Leverage ratios are often considered when analyzing fundamental data for a company. They usually consider the liquidity or bill-paying ability of the company. Low liquidity can be a signal of bankruptcy. Leverage ratios vary immensely across industries, so comparisons should be done to peers within the industry. Net working capital is not a ratio, but a dollar value that is expressed in millions. Starting with the total current assets, the total current liabilities value is subtracted to result in the net working capital based on the last balance sheet data. Higher is generally better since it implies that there are more liquid assets on hand to cover upcoming debt or creditor payments and to fund operations, although a high value might mean an inefficient use of cash or credit. For example, a company with $10 million in current assets and $5 million in current liabilities would have a net working capital of $5 million. A company with the same liabilities but only $6 million in current assets would have a much lower net working capital of $1 million. The first company is in a better position to manage short-term obligations. Advantages of leverage ratios are that they are easy to compute and to understand. The ratios give valuable information about a company's operations. Disadvantages include that ratios are not comparable across industries, which can make evaluating the companies very difficult. The general trend in a ratio over time is informative. Falling leverage ratios may imply that a company's liquidity is declining or may hold other information about a company's cash management and debt levels. Viewing the components of each ratio separately can be helpful as well. Is net working capital decreasing because current assets are declining, or are current liabilities increasing? Or possibly is it a combination of both? In this example, net working capital is well above the 10-year mean value and is a large dollar amount, close to $68 billion. A higher net working capital is preferred typically